Welcome back to our beginner's guide on how to start investing in 2026. In part 1, we covered the basics. Now, let's dive into the strategies that will help you build a strong and resilient portfolio. Ready? Let's go. First up, let's talk about diversification. You've probably heard the saying, don't put all your eggs in one basket. This is the core idea. Instead of betting everything on one company or one industry, you spread your investments across different sectors and asset classes, like stocks, bonds, and maybe even real estate. Why? Well, if one part of your portfolio takes a hit, the others can help balance things out. It's a simple but powerful way to manage risk and protect your hard-earned money from major losses. Think of it as building a team where each player has a different strength. Next, we have the magic of consistency. This is where a strategy called dollar-cost averaging comes in. It sounds fancy, but it's super simple. You just invest a fixed amount of money at regular intervals, say $100 every month, no matter what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this averages out your purchase price and helps you avoid the stress of trying to time the market, which, spoiler alert, is nearly impossible. Consistency is your secret weapon for long-term growth. It makes investing automatic and less emotional. Now, let's get a little personal and talk about your risk tolerance. This is all about figuring out how much market volatility you can comfortably handle. Your age, your financial goals, and your income all play a big role here. Are you a recent grad with decades until retirement? You can probably take on more risk for higher potential returns. Are you closer to retirement and need to preserve your capital? A more conservative approach with lower risk investments might be better for you. There's no right or wrong answer. It's about what lets you sleep at night. Be honest with yourself about what level of risk you're okay with. One of the biggest hurdles for new investors is emotion. The market is a roller coaster, and it's easy to get swept up in the excitement or panic. You'll see headlines about the next big thing or hear friends bragging about a hot stock. My advice: ignore the noise. Emotional investing, buying because of hype or selling in a panic, is a recipe for disaster. Stick to your plan, trust your research, and avoid those tempting get-rich-quick schemes. Successful investing is a marathon, not a sprint. Patience and discipline will always win out over impulsive decisions. Your investment journey isn't a set-it-and-forget-it deal. You need to review and rebalance your portfolio regularly. I recommend checking in at least once a year. Look at how your investments have performed. Have your financial goals changed? Maybe one asset class has grown so much that it now makes up a bigger chunk of your portfolio than you originally intended. Rebalancing means selling some of the winners and buying more of the underperformers to get back to your target allocation. This keeps your portfolio aligned with your risk tolerance and long-term goals, ensuring you stay on track no matter how the market changes. And that's a wrap for our beginner's guide to investing in 2026. By diversifying, investing consistently, understanding your risk tolerance, avoiding emotional decisions, and regularly rebalancing, you're building a solid foundation for financial success. It might seem like a lot, but taking it one step at a time makes all the difference. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss our next video. Happy investing!